So HP just dropped their latest earnings report, and on the surface, it looked like great news. But then, the stock tanked. What in the world is going on here? Today, we're going to unpack the really strange paradox behind HP's latest financials.
Here's the big mystery, right? How does a company beat Wall Street's predictions and still see its stock take a nosedive? Well, it's a classic lesson. What you've already done matters a whole lot less than what you're about to do.
All right, so first things first, let's talk about the good news. Because honestly, when HP announced its fourth quarter results, it really did look like a clear win for the PC and printer giant.
Let's get into the nitty-gritty. Wall Street was looking for earnings of about 92 cents per share. HP came in hot with 93. Analysts were predicting revenue of $14.48 billion. HP pulled in $14.64 billion. I mean, on paper, that is a solid beat.
And we're not talking about just squeaking by, either. That revenue figure, that's a solid 4% increase compared to last year. You know, in this economic climate, any growth is good news, and 4% is definitely respectable.
So what was driving all this? It was really their personal systems division, all their laptops and desktops. It saw an impressive 8% jump in revenue, so the company's core business looked really healthy. But that's pretty much where the good news train comes to a screeching halt.
And this brings us to the big turning point. Because the stock market, well, it's a forward-looking machine. It cares way less about the great quarter you just had and far more about the one that's coming up.
So, immediately after that earnings announcement, HP's stock dropped a sharp 6% in after-hours trading. The celebration was over before it even began. So what spooked investors so badly?
It all came down to the forecast. For the upcoming fiscal year, HP projected earnings per share somewhere between $2.90 and $3.20. The problem? Wall Street was expecting $3.33. That's a significant miss, and it signals to investors that there might be some trouble on the horizon.
So why the weak outlook? Well, HP was pretty direct about it. The company is basically bracing for the impact of, and I quote, current U.S. trade-related regulations. This is likely code for things like tariffs on components from overseas, which, directly squeeze their future profits.
Faced with this pretty challenging forecast, HP isn't just sitting back and waiting for the storm to pass. Nope, they announced a massive and frankly a painful restructuring plan to try and navigate these headwinds.
The headline number is staggering. The company plans to reduce its global headcount by 4,000 to 6,000 people. This is a huge decision with a very real human cost, affecting thousands of employees and, of course, their families.
And just to put that into perspective for you, these layoffs represent up to 10% of HP's entire 58,000-person workforce. That's a huge portion of the company that's going to be cut over the next few years.
Now, the business goal behind these painful cuts is pretty clear. HP expects this whole thing to generate at least $1 billion in annual savings once it's complete. It's a drastic move to shore up their finances.
And make no mistake, this is not a quick fix. It's a multi-year plan. The restructuring isn't even expected to be complete until the end of fiscal 2028. This tells you HP is preparing for a long-term challenge, not just a short-term dip.
But it's not all about cutting costs. HP also laid out its strategy for growth, and they're betting on a couple of key technological shifts to pull them through this. Their growth plan really boils down to two major bets. First, they're going all in on artificial intelligence, embedding it into their products. And second, they're trying to capitalize on a totally predictable tech cycle, the massive upgrade from Windows 10 to Windows 11.
HP's CEO, Enrique Lores, framed it just like this. He sees AI not just as a fancy feature, but as a core driver for everything, from product innovation to productivity. This is their big bet on the future of computing.
And what about that Windows 11 upgrade? Well, this is a huge near-term opportunity. With Microsoft ending support for Windows 10, millions of users are eventually going to need new machines. And get this, a massive 40% of HP's current users still haven't made the switch. That's a lot of potential sales.
But even with these plans, the headwinds are real. Memory costs, which make up a big chunk of a PC's price, are on the rise. And at the same time, their historically stable printer business is struggling. Revenue there is down 4% as customers just put off buying new ones.
So when you put it all together, the weak forecast, the massive layoffs, and these strategic bets, you realize HP is facing a really serious uphill battle.
And this performance gap is just stark. While the broader market, which we can look at through the S&P 500, is up a healthy 15% this year, HP's stock is down a staggering 25%. They are massively underperforming, and the pressure is on.
And this leaves us with the final question. HP is making bold, painful moves to cut costs, while betting big on AI and the Windows upgrade cycle to drive growth. Will it be enough? Can they close that performance gap and convince a skeptical market that its future is brighter than its forecast suggests? That right there is the billion-dollar question facing HP.